This is probably the most difficult problem in the chapter. I want you to take your time with this. I want you to pause along the way if you need to, and I want you to have your calculator by your side and notebook paper. So you should be writing a lot with this problem. You should be doing the math on your end. If you want to, throw this into a spreadsheet if you're comfortable, or use pen and paper, that's fine as well. Okay, so this problem deals with a stock dividend. Now, we looked at dividends at the beginning of chapter 14, and we were focused on cash dividends, the distribution of cash to shareholders. A stock dividend is also a distribution, except it's a distribution of new stock. Okay, so the corporation is taking stock that is not outstanding, and it's making the stock outstanding. It's taking the stock from the corporate treasury and putting it into the hands of shareholders. So let's look at an example of this. Say that you're a stockholder and you own 100 shares of stock, and then a 10% stock dividend is declared. Well, the effect of that is you get 10 new shares of stock. That's how a stock dividend works. We take the existing shares times the 10%, and that gets added, so this person will now have 110 shares at the end of the stock dividend. That is the mechanics of a stock dividend. Now, this has value to the shareholder. They're getting new shares. The new shares will be valued at a certain amount, and they'll have a higher quantity of shares. So we're not looking at the math from the shareholder's perspective with this problem. We're looking at it from the perspective of the corporation, okay? So just know this is kind of an example, so you have it in the right frame of mind as to what is a stock dividend. But now let's pivot over to the corporate facts and look at what we're going to do from an accounting perspective for the corporation. So the first thing to note, and I suggest this with all these problems, write every fact out, okay? It's easy to gloss over a fact if you're reading it and then attempting to solve the problem. If you force yourself, it's good practice, it's a good discipline to write every fact out, okay? Forces you to kind of take note of the information available. We have common stock. This is kind of the facts given to us before the dividend is declared. $10 par value, and common stock is worth $2,555,000 shares. $2,555,000. That means if we divide $10 into the 2.55 million, we get 255,000 shares. So do that math at home if you need to. Pause and do $2,555,000 divided by $10 par, and you'll back into the number of shares outstanding, which is what I have on the board. I've already computed it, and I'm listing it here. Next, we're told the corporation has $530,000 of retained earnings. Remember, retained earnings are earnings that are accumulated over time. Okay, so revenue less expense equals net income. The income at the end of the period gets shifted into retained earnings. Okay, so this is what's on the balance sheet before the stock dividend. Then we're told the stock dividend is declared. It's a 10% dividend. And we're also told that each share had a market value of $15 per share. So now we're going to have to, again, contend with market versus par value. And we'll get to that in a moment. And I have down here a little note. $15 market minus $10 par equals $5. And remember that $5 is called excess of par. So remember, we want to capture and retain and kind of use the terminology we learned from chapter 13. We're applying it more in this chapter as well. Okay, the 10% stock dividend, we are told in the problem, resulted in a distribution of 25,500 shares. So that's kind of this piece here. 25,500 shares were distributed to all shareholders, and they're, of course, split up properly among all the shareholders. So from a corporation perspective, we need to solve for the blanks here. In the problem, you're asked to solve for this, and this piece, okay? I believe it's common stock par. Let me make sure I'm correct on that. Apologies. You're asked to solve for total stockholders' equity, which is down here. Okay? Total stockholders' equity, outstanding shares, and par value per share. So those are what you have to solve for before and after the dividend for purposes of your homework for the software, but you actually have to you have to kind of work through all of this that's on the board to do it. All right? So this is part of what makes this a difficult problem, is that there's a lot of math and a lot of moving parts. Outstanding shares, we've seen some of these already with the given facts. Outstanding shares, 255,000. Okay, we looked at that before. Par value per share is $10. Now I'm going to make a note here. Par value after the dividend is also going to be $10 per share, and that's because we have to recall par value is the value listed on the share of stock, right? So remember back in chapter 13, we looked at market value versus par value, and we were told, par value is kind of this arbitrary value printed on each share of stock And that's what this is. So that it doesn't change. Par value stays what it is for the life of the corporation. Okay? Common stock par value, the value of the common stock, the par value is $2,555,000. And that's taken right from the problem. Paid in capital in excess of par is zero right now. Before the dividend, that is zero. And again, we kind of infer that from the problem, okay? And by that, I just mean we weren't told that there was any paid in capital in excess of par. We were simply told that we had this information here. Retained earnings is $530,000. Total stockholders' equity is the $2.55 million plus the $530,000 for $3,080,000. Okay, you have just solved the before portion of the problem. Okay, this information will help you solve that before portion. Now let's look at the 10% stock dividend. Outstanding shares. We have 25,500 new shares that are distributed out into our shareholders' hands. So we take our 255,000 plus 25,500. We now have 280,500 shares. Okay, that's all. It's basic arithmetic. We're adding new shares into and distributing it into the hands of shareholders. We already noted that par value doesn't change. Now let's look at tracking par and excess of par. Okay, we're going to go back to a Chapter 13 concept that we looked at a couple weeks ago. What we want to do is we want to take this stock dividend amount, the quantity of shares, and we want to reflect that they have been distributed into the marketplace. But remember, we have to track par and then excess of par. So we know the par value is $10, okay? And what is excess of par? Well, the excess is the market value. So any market value in excess of par, this 5 is what we're looking for. The $5 is the value being distributed per share in excess of par. So we want to look at that. Basically, 25,500 times $5, okay, is my excess amount. All right, well, the dollar value here is going to look something like this. $255,000 being added to our common stock par value account. Paid in capital in excess of par is going to be $147,000. I think it's 200. I'm going to do the math right now. You won't have to pause because you can wait for me doing the math. 25,500 times 5, 127,500. You can see I just did the math there. I want you to do the math here. You're not going to learn this unless you do it yourself, okay? All right, so what we've just done is we have added value to our par, common stock par account, and our paid in capital in excess of par account. We started out at 0 here, so this is a pretty easy sort of walk this way. The $2.55 million plus the $25,500 gives me $2,805,000. Okay. So if we have par value going up and paid in capital in excess of par going up, where is this value coming from? Right? That's the next logical question. It's coming from retained earnings. So just like with the cash dividend, we distribute cash and cash goes down and then retained earnings goes down. A similar kind of mechanic is happening here. We are distributing value into the common stock par account and the paid in capital in excess of par account from retained earnings. Okay? So what effectively is happening here is we want to show that retained earnings is going down by the sum total of the amount being distributed. Okay? And that sum total is, I'm going to do my math again, $382,500. So this $382,500 is being distributed in the form of excess of par and par. So if you add 255, again, do the math at home. 255 plus 127.5 gives you 382.5, okay? I'm just abbreviating my numbers here. Okay, 530,000 less 382,500 gives me a retained earnings balance of 147.5 after the distribution happens. We need all these pieces to solve the problem of bottom line stockholders' equity. And look at what we have here. If you add 2,805,000 plus 127,500 plus 147,500, you get $3,080,000. It's the same as before, okay? Our total stockholders' equity, the bottom line total, has not changed. And it's because we've shifted value out of retained earnings into the hands of shareholders in the form of stock, okay? And that's one way, that's kind of like the big picture here, is a stock dividend is shifting, is taking value that the company actually has on its books in its retained earnings account, and is transferring that value from retained earnings into stock that is in the hands of shareholders. Okay? This problem is difficult. It takes time, and it may take you kind of pausing, rewinding. It may take you going into the book, but work at it. Okay? Do the work. You will pick it up. You'll learn it, and once the puzzle pieces kind of fit together, you will have a better understanding of a corporate balance sheet, the equity portion of a corporate balance sheet. Okay? It's particularly with respect to par, excess of par, and then retained earnings. Okay? Keep in touch with questions as you have them, and I hope this was helpful. Thank you.